Intel Capital is at the top of this list. Its corporate venture capital unit, which survived the dot-com bubble that claimed many of its peers, saw more exits since 2009 than any other VC, topping traditional venture firms such as Excel Partners and Sequoia Capital. While it does not have a formal corporate venture capital unit, the advertising holding company Interpublic Group made a nearly 100 times return and a profit of over $225 million in the IPO of Facebook, from its 2006 investment of $2.5 million, plus a commitment to purchase $10 million in ads on the network on behalf of clients. Additionally, consider Qualcomm Ventures, which had a pretty good run in late 2015 and early 2016 with its startup investments. The company made over $100 million when the fitness tracker Fitbit had its IPO in the summer of 2015. More success followed when Cruise was bought for $1 billion plus, and Qualcomm was the third largest shareholder after investing only 3 months earlier, in November 2015. All of these examples clearly deliver on Buffett's definition of investing to get more money back in the future. Matrix of corporate investment. This rise in corporate investments comes for a multitude of reasons. Harvard Business Review, or HBR, studied those rationales and crafted a matrix framework to map corporate VC investments. Broadly speaking, this corporate investment matrix is defined by 2 characteristics: the objective and the degree to which the operations of the investing company and the startup are linked. Objective. Deals can have both financial and strategic intent. Strategic deals are made primarily to increase the sales and profits of the corporation's own businesses. Financial deals are made where a company is mainly looking for attractive returns. Linked to operational capability. This can range from tight to loose and relates to how closely an investment relates to the current business of the corporation. These 2 dimensions yield 4 types of corporate investments: driving, enabling, emergent, and passive. There is no right or wrong quadrant for a corporate investment, as each depends on the overall company strategy. It is important to note that even when the objective is more strategic by nature, capital gain must still be a driver. This aligns the incentives of the corporation with those of the entrepreneurs they are backing and their fellow venture investors. With that said, a strategic objective can have multiple outcomes for both the investor and the investee. Corporate investment may be used to identify new products, services, or technologies to replace existing corporate offerings. These investments can help a company gain a window into new technologies and new markets, import or enhance innovation within existing business units, or even identify potential acquisition opportunities. Another role that corporate investments may play is to complement corporate businesses by funding ventures that increase the value of the corporate ecosystem. This is a strategy that the corporate chat service Slack deployed with its recent $80 million fund, which will invest between $100,000 and $250,000 in smaller startups building applications that work with Slack's messaging service. Appetite for investment. One traditional industry that is just starting to turn to startup investment in the face of industry change is the packaged food business. The food industry has faced many challenges over the last few decades, from rising commodity prices to changes in government subsidies and regulations. However, 2 massive trends in particular are causing these businesses to re-examine their fundamental approach. Rise of natural and organic. Consumer demand has grown by double digits every year since the 1990s, and organic sales have increased from $3.6 billion in 1997 to over $39 billion in 2014. Organic food is $35.9 billion of that $39 billion. Organic and natural food sales now represent almost 8% of total U.S. food sales. Shift from grocery stores to restaurants. Before the 1900s, most Americans spent 10 times more on grocery purchases than restaurant spending. By the 1950s,